Wall Street. The name alone carries power, wealth, and prestige, but behind the glittering facade of the financial capital of the world lies something darker: its role in global crises. From the Great Depression to the 2008 financial crash and even the COVID-19 pandemic, Wall Street's influence has shaped not only the American economy, but the world's financial stability. What you're about to hear may surprise you: the untold story of how Wall Street's actions contributed to some of the most devastating crises in history. Stay tuned. Let's start with the Great Depression, the worst financial collapse in American history. The year was 1929, and Wall Street was booming. Stock prices were soaring, and everyone wanted in. But here's the thing: speculation was running wild. People were buying stocks on margin, borrowing money they didn't have, all in the hope that prices would continue to climb. But of course, it didn't last. On October 29, 1929, the stock market crashed, a day forever etched in history as Black Tuesday. In just a few days, the market lost more than $30 billion in value, sending shockwaves across the globe. Wall Street's unchecked greed, lack of regulation, and speculative frenzy caused massive damage. But here's the shocking part: many investors saw the crash coming, yet Wall Street's insiders and elite bankers continued to gamble with people's futures, ignoring the warning signs. The result? Unemployment soared, and the world was plunged into a decade-long depression. But how much of this was Wall Street's fault? How much did its reckless behavior contribute to the global financial collapse? The answer is more than you might think. Fast forward to 2008. Nearly 80 years after the Great Depression, the world was facing another catastrophic financial meltdown. This time, the cause wasn't just stock speculation, but something more complex: subprime mortgages, toxic assets, and unchecked financial products. Wall Street had innovated the world of finance, but with new innovations came new risks. Bankers were making billions by bundling bad loans, mortgages given to people who couldn't afford them. And here's the kicker: they sold these loans as secure investments to people around the world. But when the housing market collapsed, so did the global economy. In the blink of an eye, Lehman Brothers filed for bankruptcy, sending the financial world into chaos. Banks froze, lenders panicked, and soon, the entire economy came to a screeching halt. Main Street was left in shambles. Millions lost their homes, their jobs, and their savings. Yet the people who created this mess, Wall Street executives, walked away with golden parachutes. What went wrong? Wall Street's obsession with profit led them to create financial products that were too risky, too complex, and too poorly regulated. And despite the bailouts, Wall Street's behavior remained unchecked. The 2008 financial crisis was largely a consequence of Wall Street's greed and lack of accountability. But was it really the end of the story? Not quite. Let's talk about the most recent crisis: the COVID-19 pandemic. In March 2020, the world was hit with an unprecedented health emergency. The virus spread like wildfire, forcing governments to lock down economies, close businesses, and push millions of people into unemployment. The stock market? It crashed hard too, with the Dow Jones dropping thousands of points in a matter of weeks. Now Wall Street's response was remarkable, but not in the way you might think. While millions were losing their jobs, the rich got richer. Major banks and corporations were given stimulus checks and bailouts. Meanwhile, Wall Street was thriving again as stocks rebounded almost immediately, largely due to government interventions and the massive quantitative easing policies. But what does that tell us about Wall Street's role in the COVID crisis? Well, the pandemic highlighted the financial system's unequal foundation, where the wealthiest people and corporations were insulated from the pain most others were feeling. While average Americans struggled, Wall Street bounced back in record time, profiting off the crisis. This raises an important question: how much did Wall Street's behavior exacerbate global crises, And what role does it play in shaping the economic recovery? So, what can we learn from these events? Wall Street has played a key role in shaping global financial crises, but it hasn't always been the cause. It's been a major catalyst, driving market behavior, fueling speculation, and sometimes even creating the conditions that lead to disaster. But the role of Wall Street is complicated. Sure, it's been involved in some of the worst economic crashes in history, but it's also been a driving force behind global recovery after those same crises. It's a system that constantly evolves, often at the expense of the everyday worker. As we look toward the future, the question remains: will Wall Street learn from its past mistakes? Or will it continue to be a ticking time bomb in the world's economy? The stakes are high and the risks are as real as ever. In the end, Wall Street's role in global crises is undeniable. Its influence is both immense and dangerous, depending on how it is managed. As long as it remains at the center of global finance, its actions will continue to affect us all, for better or worse. What we've learned is simple. Reckless financial behavior doesn't just hurt the rich, it hurts everyone. But maybe, just maybe, we can find a way to make Wall Street work for everyone, not just the elite few. Thanks for watching, and if you want to learn more about how Wall Street shapes the world, don't forget to like, subscribe, and comment below. Let me know your thoughts on Wall Street's role in the next global crisis.